kicking it over to Alan. What did the debt capital picture look like before that declaration of emergency, and what has changed since then?
Things have changed quite significantly. It's funny, we always talk about the different functions being cyclical and how you start somewhere, you end up somewhere else, and eventually get back to where you started. When we first started this business in 2014, the private lending industry, for the most part, was dominated by local mom and pop shop lenders, often referred to as hard money lenders, small family offices, etc. When we started our business at Sharestates, we went out and really started exploring the institutional world for the first time, speaking to large hedge funds, private equity groups, asset managers, and there was a huge educational barrier there. And ultimately what ended up happening was when we spoke to these larger groups, they would look at our paper, they would see a 10, 11, 12, 13% coupon associated to the loan, and they would say, well, this deal is probably too hairy, it's not going to fit for us. And they were strictly saying that based on the interest rate of the loan. Over the last 5 or 6 years, there's been quite a bit of education in that space. We've seen the institutional world and the Wall Street world start pouring into this space, looking for higher yields and looking for these types of assets, because they essentially came to the conclusion that it's not a risky asset. An interest rate is not necessarily indicative of risk. It took them some time to understand what these loans were, what the assets were, and why they were necessary. But ultimately, they found comfort in that, and that ended up causing a pretty major paradigm shift. What I mean by that is, in the private lending world, and I think just in general in the lending world, there's always a give and a take between the lender and the borrower. And I think for a very long time, the borrowers had a very unique relationship that they had to manage with their lenders to make sure that the lender always saw them in the best light. They had to really earn the lender's trust, and ultimately lending was scarce, so borrowers didn't have a whole lot of options. Over the last 4 or 5 years, that's changed as a result of supply and demand and capital pouring into the space, and this institutional and Wall Street capital chasing these borrowers. All of a sudden, everybody was chasing the borrower. There was a ton of competition, ultimately, which led to a lot of yield compression, both in terms of the rate as well as origination fees and other fees that were getting charged. And all of a sudden, we had this flooded environment where everybody and their mother could be a private lender, and borrowers just had a ton of options. All of that really has come to a screeching halt in the last 30 days. A big part of that is that when you had institutional capital pour into the space, the institutional world, for the most part, by definition, is leverage on leverage on leverage. So what I mean by that is you had institutional counterparties that would go out and set up warehouse lines with other institutional lenders. They would create these structured finance vehicles with A and BP structures, and ultimately they would take whatever capital they had and they would leverage that up to a larger fund size. And then taking it a step further, you also had a number of investors that would actually securitize this product as well. So when everything kind of started going downhill in early to mid-March, the institutional world was the first to feel it. They took a step back and they said, hang on a second. How is this going to affect us? If there are stay-at-home orders, if there are tenants that are unable to pay their bills, if there are stop work orders at construction sites, do we want to continue funding these assets? The market responded to that by basically saying no, for the most part. So warehouse lenders started hitting their borrowers on margin calls, which ultimately translated into those borrowers, those investors needing to come up with liquidity, which made them unable to purchase these private loans that were getting originated by the lenders to these underlying borrowers on the assets. The securitization market blew up to some extent. That cheap source of capital in the 3 to 3.5% range basically disappeared overnight, and it basically froze up the Wall Street world, which very quickly caused capital for various types of lenders to dry up and ultimately borrowers to lose their funding in some instances. So we've seen, again, going back to where I started, a return of that paradigm to there being fewer lenders in the space and now borrowers really looking for those quality lenders and trying to get their attention to say, hey, I'm the borrower you want to lend to.